So if you're in business and you've run across this term depreciation, maybe in a meeting or maybe some other managers talking about it, you may want to understand it a little bit more because there's a lot of misconceptions about what depreciation is. So there's a lot of misconceptions about depreciation. What we're going to talk about in this video is more along the lines of an overview of it. In other words, what it is and what it isn't, so that you can better understand it. And if you want to learn more about the calculations that are needed for depreciation, you have to check out some of the other videos I have. So to start out with, depreciation is based off of what we call an asset in business. Now, not all assets are depreciated, but we'll talk about which ones are and which ones are not. But what that means is that a business needs resources in order for the managers to do their job. So, for example, I have an example of a restaurant right up to the top left. And with that restaurant, if you want your managers to do their job, they need stuff, they need their resources to do it. For example, they need glasses, they need plates, they also might need equipment in the kitchen like a stove or fryers. Those are all the resources that managers are going to need to do their job in a restaurant. Those are assets. So that's what an asset is, the resources that the managers need to do the job to run the business. Every business has different types of assets. For example, if you are a manager that runs an airline, you need a different type of asset. One of the key assets you would need would be an airplane. And if you run a factory, right, you need to have a factory building and you need the equipment in the factory. So every business has some level of resources, but depending on the type of business, they're going to have different types of resources. So the assets are going to look different depending on what the business is. Here's an example of a balance sheet that shows the assets of a business along with the obligations, which we call liabilities, and the equity. But for our purposes, we're just going to focus on the assets. So for this coffee shop, they need cash, they need inventory, they need supplies, and they also need equipment. And so that's kind of where we're going to be focused, is the types of assets that the managers use for over 1 year. So cash is usually something that's used up. They might generate more cash, but the cash is there for their short-term needs. The inventory is there for their short-term needs. The supplies are there for short-term needs. In business, typically short-term is about a year. So the current assets are all those things they need for the short term. Those things do not get depreciated. But the long-term assets, like the property, plant, and equipment, like the building that the coffee shop is in, or the equipment that's used, those are going to be used for many years. And so that is where the depreciation is going to come in. Notice I have equipment, net. What that means is that I've netted out the depreciation from the original cost of the equipment. So again, just to reiterate, the current assets are assets that the managers need in their business in order to run the business on a day-to-day basis. And these are assets that are generally going to be needed within a year. So for example, inventory is usually gone through within a year. You don't usually see inventory on a store or shop that lasts longer than that. The cash is a current asset. Again, we said this earlier. Well, why is that a current asset? Because even though you always see cash on the balance sheet, the cash is there for their short-term needs. Supplies would be another example of business supplies. So this is just some supplies for an office. So they buy their supplies from time to time they need them. They're not going to be using the same supplies for over a year. They'll replace them as they need them. But let's look at something that would be used for longer terms. Let's use a farmer. And a farmer needs to have a tractor. And that tractor costs a lot of money, but the tractor is going to be a resource available to the farmer for many years. Let's say the tractor is going to be used for 10 years, right? And so we're not going to put the asset on the books as a current asset because it's going to be used for a long time. Instead, what we want to do is we want to put it on the books as a long-term asset, property, plant, and equipment. In this case, we have some equipment for the farmer. Let's look again at the coffee shop. And the coffee shop has equipment that they need that they're going to use for many years. So let's say they have some very expensive espresso makers and coffee makers. That's their equipment. And they're going to use these, and we'll just say they'll use them for 10 years. And they're going to depreciate them every year by $1,000. So we're going to depreciate these coffee makers over $1,000 per year over 10 years. This is how it's going to work on our financial statements. So going back to the coffee shop, we see that we have our current assets at the top, but then what we're going to focus on is the equipment that we said we had as our long-term assets. We said we were going to depreciate those over 10 years. To make it easy, we said it cost us $10,000 and we're going to depreciate $1,000 each year. So every year we depreciate, meaning we use the equipment for 1 year and we take $1,000 of value off of the equipment. And you'll see that on the income statement showing the profitability, we take an expense of $1,000, the same amount that we used to go into depreciation. So each year we'll add $1,000 to accumulate depreciation, but the income statement will use the same amount of depreciation. So the depreciation expense will be $1,000 each year. Since you're looking at the profit for the year, you only show the expense that you took for that year. But for the balance sheet, you're showing the accumulated depreciation, meaning all the depreciation that's ever been taken for that equipment. Eventually, the equipment will get down to where it's got a value of 0, and at that point, if you decide to keep the equipment, you just let it ride at 0 value. That's called the book value. Taking the equipment minus the accumulated depreciation. That gives you the book value. To do that, you're going to use a journal entry. So a journal entry is just putting the depreciation on the books. And so you always do the debit first. So you'll debit the depreciation expense. Whenever you debit an expense, that increases the expense, and that puts it in the debit column. You always put the debits first in the journal entry, and then any credits you have go second. The credit side is going to be the accumulated depreciation. Whenever you credit an asset, it reduces the asset. And remember, that's what we're doing with accumulated depreciation. We're reducing the value of the asset over time as we use it up. I hope you like this video. If you do, visit my website, Accounting Hound. If you go to accountinghound.com, you'll see that I have a lot of resources there to help you understand accounting, including some courses that I have provided for you. So these are full courses, and the very first course is totally free. So you could take that accounting course if you wanted to. If you scroll down, you'll find there's additional courses that go into even more depth and into other topics that you might find interesting. Thank you.